As of 10:47 a.m. Eastern Time on Wednesday, January 28, 2026, Amphenol, trading under the ticker APH on the New York Stock Exchange, is currently priced at $143.49 per share. This represents a staggering intraday drop of $22.76, or roughly 13.69% from yesterday's closing price. While the broader market indices are showing varied movement, Amphenol is enduring its worst single-session percentage decline in over a quarter of a century. This sharp downward move is particularly jarring because it follows a quarterly report where the company actually beat expectations on both the top and bottom lines. The immediate insight here is that the market is no longer rewarding simple beats. It is ruthlessly punishing any perceived vulnerability in forward-looking growth or valuation sustainability. For months, Amphenol has been a quiet darling of the high-tech infrastructure world, often moving in the shadow of NVIDIA stock or even Apple stock as investors looked for the hardware and connectors that power the physical infrastructure behind the AI boom. However, today's price action serves as a loud reminder that even the most robust fundamental performers can be vulnerable to a sell the news event when expectations are priced for perfection. Investors using an individual brokerage or those monitoring their positions via the Fidelity mobile app might be shocked to see such a deep red candle on a day when the headlines actually read record Q4 results. This creates a curiosity loop. Why would a company reporting a nearly 50% increase in sales be the worst performer in the S&P 500 today? The common ground among market participants has been that Amphenol is a safe, high-margin play on the expansion of data centers and the electrification of everything from cars to industrial equipment. The prevailing narrative suggested that as long as the demand for interconnect systems remained high, the stock would continue its climb, which had seen it gain 23% in just the first few weeks of 2026 alone. However, today's price action serves as a loud reminder that even the most robust fundamental performers can be vulnerable to a sell the news event when expectations are priced for perfection. Investors using an individual brokerage or those monitoring their positions via the Fidelity mobile app might be shocked to see such a deep red candle on a day when the headlines actually read record Q4 results. This creates a curiosity loop. Why would a company reporting a nearly 50% increase in sales be the worst performer in the S&P 500 today? The common ground among market participants has been that Amphenol is a safe, high-margin play on the expansion of data centers and the electrification of everything from cars to industrial equipment. The prevailing narrative suggested that as long as the demand for interconnect systems remained high, the stock would continue its climb, which had seen it gain 23% in just the first few weeks of 2026 alone. However, today's price action serves as a loud reminder that even the most robust fundamental performers can be vulnerable to a sell the news event when expectations are priced for perfection. Investors using an individual brokerage or those monitoring their positions via the Fidelity mobile app might be shocked to see such a deep red candle on a day when the headlines actually read record Q4 results. This creates a curiosity loop. Why would a company reporting a nearly 50% increase in sales be the worst performer in the S&P 500 today? If you are engaged in online investing through platforms like SoFi Invest or using the interactive brokers trading tools, you can see the sector momentum shifting. In previous months, any company associated with the plumbing of the digital age was treated with the same reverence as a high-flying software firm. But today, the macroeconomic pressures of sustained interest rates and a cooling in certain industrial segments are finally catching up to the hardware sector. The expectation was that Amphenol would provide an outlook that completely disregarded any potential slowdown, but reality showed a management team being pragmatically cautious. This caution is being interpreted by the market as a sign that the easiest gains of this cycle are now in the rearview mirror. Amphenol is a massive operation. It is one of the world's largest designers and manufacturers of electrical, electronic, and fiber optic connectors. They are the people who make the actual physical plugs and sensors that allow your car to talk to its sensors, your phone to connect to the network, and a server in a data center to communicate with the rest of the web. Their business model is built on an entrepreneurial structure where hundreds of different business units operate with a high degree of autonomy. This has historically allowed them to be incredibly nimble, acquiring smaller competitors and integrating them quickly. This is why many people seeking investment help or using a SoFi robo-advisor often find Amphenol tucked away in diversified tech or industrial portfolios. It's a company that has managed to grow its top line at an average rate of over 20% for the last few years, a feat rarely seen in the industrial hardware space. Looking back at older reports, Amphenol has consistently delivered. Their profitability margins, with operating margins often exceeding 20%, have made them a staple in many Fidelity mutual funds and Fidelity ETFs. For the full year 2025, they saw sales rise 52% to $23.1 billion. That is not a typo. To grow a company of this size by half in a single year is monumental. Much of that was driven by the IT datacom market, which is the specific segment feeding the AI build-out. When you hear about the massive demand for NVIDIA stock, you have to remember that those chips need to be connected to boards, and those boards need to be connected to racks. That's where Amphenol comes in. They provide the physical connective tissue for the modern economy. However, we need to address the valuation. Before today's crash, the stock was trading at a price-to-free cash flow ratio of nearly 57. By comparison, even some of the most aggressive growth stocks don't carry that kind of multiple for long. This is why investors on investing sites and those managing their own individual brokerage accounts are seeing such a sharp correction. The gap between what the company is actually worth in terms of present cash flow and what the market was willing to pay for future growth had become too wide. When the guidance for Q1 2026 came in with earnings per share expected between 91 cents and 93 cents, it was a solid number, but it wasn't the moonshot number that would justify a 50x multiple. Comment below how many shares of Amphenol you currently hold or if you are looking to buy this dip. I'm curious to see if the sentiment here matches the carnage we are seeing on the charts today. Moving into the future outlook, there are several scenarios to consider. The first is a period of consolidation. After a drop this severe, it's rare for a stock to V-shape back to all-time highs immediately. We are likely to see a base-building phase where the stock finds a floor, perhaps around $135 to $140 level, as the long-term holders in Fidelity Wealth Management or Schwab Intelligent portfolios reevaluate their positions. The main catalyst to watch will be the integration of the CCS business from CommScope. If Amphenol can prove that this acquisition is even more accretive than the 2 cents per share they've currently guided for, the stock could find a new leg up. There are also significant risks. If the broader tech sector, specifically the hardware and semiconductor space, continues to face valuation scrutiny, Amphenol could be dragged down further regardless of its individual performance. We are seeing a lot of self-investing individuals moving toward Robinhood crypto or Robinhood fractional shares to find volatility elsewhere. But for the serious investor using Fidelity IRAs or sophisticated interactive brokers account setups, the focus is on the cost of capital. If Amphenol has to continue borrowing to fund its acquisition strategy in a high-rate environment, the growth through acquisition model becomes more expensive and less effective. The tension between expectation and reality is the defining theme of today's market action. The expectation was that Amphenol was an unstoppable force that would eventually trade at $200 regardless of the underlying math. The reality is, Amphenol is a high-quality, cyclical industrial company that has been caught in a speculative bubble. It is still the same company it was yesterday, profitable, dominant in its field, and led by a disciplined management team. But the price people were willing to pay for those qualities was simply too high. This disconnect is being bridged today in a painful, high-volume correction that is catching many off guard. When you look at your online investment dashboard today, whether it's through the SoFi Active Investing tab or your Fidelity Brokerage overview, don't just look at the percentage drop. Look at the underlying numbers. Revenue is still growing at a double-digit clip. Profit margins remain in the top tier of the industry. The company is still returning capital to shareholders through buybacks and dividends. The crash is more about the market's psychology than the company's biology. For those who practice self-investing and have a long-term horizon, these are the moments where the intelligent portfolio approach is tested. Is the long-term thesis still intact? If you believe that the world will continue to need more connectors, more data centers, and more advanced electronics in vehicles, then the core reason for owning Amphenol hasn't changed, only the price has. In summary, the central insight of this analysis is that Amphenol is currently the victim of its own success. Its stock price outpaced its fundamental growth, leading to a situation where a record-breaking earnings report became the catalyst for a double-digit sell-off. The contrast